one thing we see in the Facebook group a lot is when people engage with a financial advisor, they are scared, one, because of the fee, okay?
Mm-hmm.
Now, it is not uncommon, and I just want to preface, if you go to a financial advisor, before you reach out and engage, please note at this time in Australia, given the literally lack of supply of financial advisors, so we've got a supply and demand issue, okay? There are 50% less financial advisors now in Australia than what there was 5 years ago.
Yep.
Okay. So basic economic supply and demand layered with the regulatory cluster F with the compensation scheme of last resort. Google that one, friends. You know, Martin's paying an extra $7,000 per advisor in his office for the sins of a company in the past, and the government doesn't want to cover them. They said they would. They changed their mind. Google that. That's wild. The fact is, if you want to engage with a financial advisor for personalized financial advice, I'm going to need you to get ready to part with $5,000 to $6,000 as a minimum as a once-off. Okay? Where I'm going with this, I'm glad you asked, Martin. What I want you to do, because that is a lot of money, absolutely a lot of money.
If you paid an accountant $300 a year to do your tax, well, in financial advice and accounting advice the same, should I pay $300? No, there's a lot more work involved. There's a lot more value involved, but we're looking at a lot more in assets to protect.
Yeah. So what I want you to do, because there was a question in the Facebook group just today and we're talking, I want you to do this. If you had we'll say it's a little bit higher than that $5,000 as an example, $6,500 advice fee as a once-off. Divide that cost by your super balance. Let's do that. We'll call it $800,000. Let's call your house worth $1 million or $800,000. So let's go 6,500 divided by, we'll just call it 1.8 million, your house and your combined super.
Yep.
That is 0.36% of your net worth. I need people to start to understand when we are coming into retirement, you need to step back, understand that yes, $5,000, $6,000, $7,000 is a lot of money. Most people wouldn't spend that on one holiday. I get that. But if we step back and say this household could be worth 1.5 million, 1.8 million, do we want to spend 0.36% of our net worth to make sure, which is, $5,000-6,000, to make sure we don't cock this up and make a $50,000 mistake?
Yeah.
Do we want to? So that's on the upfront fee. There is a myth out there that every financial advisor wants you to have an ongoing relationship. That's simply not true. Simply not true. You can go and get once-off advice. You can go and say, this is my situation. Can you do a strategy paper for me? Can you do a statement of advice? Just make some recommendations. You can run along and look after that. Totally okay. Where I want to get to, Martin, if someone, do you know, and we'll beep this out, do you know how much my parents are paying you each year-ish?
Yeah.
What is it? I'll beep it out.
Yeah, $5,000 or $6,000.
Yeah. Okay. All right. I'm not going to beep that out because it's a good example. So my parents have average
great financial advisor.
And he's a mighty stallion. Yeah. They pay you, Martin, $5,000 to $6,000 a year out of their bank account.
Yep.
How many? And this is where we really get. It's this psychology mind F of this ongoing advice. How many clients that pay you an ongoing service fee at the moment have called you and said, Martin, what's going on? Should we move all this stuff to cash? How many of them, if they called you, you've said, Oh, absolutely. Yeah, move it to cash. It's too rocky out there. It's safe. Do that. How many?
Zero.
Okay. How many have you talked with who have concerns?
So I'd say in the last week, and different weeks be different, I've spoken to lots of clients, but I suppose reached out for the markets exclusively, 5 or 6.
Yep.
Let's call that 6. 5 of them have reached out and said, hey, I'm seeing what's in the markets. 5 of them have said, I want to move more into the markets.
Okay.
One of them has said...
Wasn't expecting that,
No,
but I'll buy it. I'll buy it.
One of them has said, I'm scared, should I go to cash? 5 of them actually said, is now a good time? And while I'm on that roll, and I'll throw the ball back to your court shortly.
No, I had a big rant.
Do you want to go with your rant or go with mine? Okay.
You go.
So we do, as many advisors do, have a strategy, and we have these buckets. We have a philosophy. We set that up originally, and we monitor that every year for our clients, whether they're on a wrap account or an industry fund or whatever. It doesn't matter. We monitor that and we communicate with them in January every year, and we did that this year, saying, "Hey, your retirement wealth is X. Within that, this much is in a conservative, defensive cash bucket. Based upon your withdrawals of X amount per month, you have X amount of years not exposed to the market." We don't know what the year ahead is. Perhaps now sitting in April, we kind of probably had an idea. We don't know what's ahead, but we know is the markets have been really good. They'll be rocky at some point in time. We're comfortable you've got enough ammo, cash reserve, to get you by. So why do I think we haven't had many calls is because our clients have got a strategy.
And they're comfortable and educated.
Exactly. They have a plan. They know what they're doing. They know why they're doing it. They know it's not just someone set up a few years ago, but we took that out for the car. We did this. Have we still got enough or not? We adjust that every year. And there were a couple of clients that we looked at and went, because you did do that, you've only got 2 years. We'd probably prefer you to have, everyone's different, not personal advice, but we benchmark it closer to 5 years. For exactly those analogies you're talking about before, how long does the market generally take to recover? And so we said to some clients early this year, we want you to take out $50,000 and top it up, or $100,000 and top it up. So exactly, clients have a strategy. They're working with an advisor who knows. On the fee side, yes, a lot of our clients have pay an ongoing advice fee. That is always less than 1%. Somewhere probably between 0.5% and 1%.
But it's a flat fee.
It's a flat fee.
Yep.
It's not a percentage. It's not a commission. It's a flat fee.
But it's nice to work it back to
relate it. Because, yeah, 6,000 looks like a lot.
Yeah.
But if we're looking after, and even if we ignore the house for a second, you've got a rental property, you've got this, you've got retirement assets of, $1 million or 1.5, that's 0.5%. Now, when you're talking about the market moving by 6% in a week, or we're talking about death taxes for children, or we're talking about settling strategies, we're recovering that 0.5% very comfortably for all of our clients. We don't mandate clients stay with this forever, but we will offer that service. We think there's value. And a lot of our clients come to us with certain complexity because of our skill sets. And I'll finish up in a second, but 94% of our clients renew every year.
Yeah.
They go,
They see the value.
We see the value.
Yeah.
Probably the 6%, probably half is, hey, when we're ready, we'll look after itself for a couple of years, or we'll actually say to them, now this is all sorted, you're retired, you're set up, our minimum fee is X. We don't think you're probably going to get value from that anymore. About half of them say, thanks for that, Martin, thanks for being honest, we'll come back to you if this changes. The other half say, hell no, I'm not going to do this by myself. The fact that you can fill out that form, you call me, the fact that I can pick up the phone and your team knows what's going in my life and I can reach out to you when this week happens. And that was that one client with that client who was concerned about the markets. We've recovered or protected them much more than that 0.5% or 0.6% or 5 or 6 or 8 grand or 10 grand a year that they pay us.
And I really just wanted to camp on this because I've got such a passion for making sure people don't panic and do wild stuff. And this is a PSA, and I will legitimately, in the Retire Right Facebook group, I am turning off comments when there's misinformation around financial advice, wrap accounts, industry fund, all of that, because it's literally misinformation. Yeah. Now, you might disagree with me. If you do, please go to the website, send me an email. I'd love to let you vent to me. But on that, if someone had a $500,000 super balance, didn't pay an ongoing advisor, and you don't have to, like,
Yeah.
I don't care. That's fine.
And even the clients who do, they can opt out of that at any month.
Yeah. I'm just saying you've got to not see it as I'm paying $5,000, $6,000 a year, whatever it is, based on your situation. I need to get at least $10,000 back because of that. What if you didn't have an advisor? What if you did? And I say this because I literally, coming out of the GFC, had 3 clients come to me that were sitting in cash
Yep.
for 4 years out of the GFC. Okay.
They sold to protect their money.
Yep. I can categorically tell you now, it cost them hundreds of thousands of dollars. If you had $500,000 invested in the market, if you move that to cash because you were panicked and worried, and the market rebounded like we saw, if you missed a 25% swing up, that, my friends, $125,000 that you've missed out on, that you've literally lost.
Never getting back.
Opportunity cost.
Yeah.
So my parents, they are paying an ongoing advice fee for insurance, for knowledge, for hand-holding, for strategic advice, for Martin to say, and if you're a financial advisor, clip this and send it to your clients. I don't care. They are paying you because when the going gets tough, they need someone that they trust and knows their situation to make sure they don't make a $100,000 mistake.
Yeah.
Now, if I may finish.
I've got more to add, but
okay. You go because I'll compose my thoughts.
So even on that, I had two other conversations this week. One was with a client, and I put this up on LinkedIn, but I might share it even within the Facebook group as well. A client we worked with for 5 years. They came and saw us in 2020, didn't know where things were at. They actually and so they needed advice. After 5 years, we're still working with them. We send them a little gift to say, thanks for working for 5 years, looking to work with you in the future. They wrote back to us and said, they reached out to say, thanks for the gift. Lovely working with you. We want to keep working with you. Can't believe how much we've achieved in 5 years and how different our world is back then. That they were still working. They had 2 properties. One they were going to move into they had a home, they had a rental property, they could move into rental property as a future house. They were employees, et cetera, et cetera. We built a 5-year, 10-year plan for them. But life doesn't go in a straight line. They went from having to be employees to being self-employed. So their tax and contributions had to change. Their wages changed as a consequence of that. The house they were going to move into was a rental property they moved into earlier because the property market boomed. They got a really good price on their other one. They spent about a year with council to get plans put together. Then all of a sudden a developer came knocking and said, hey, we want to pay you this. And they went, we're silly not to take that. Let's go and move into a house that's already done. So the house they live in now wasn't on the radar. They've sold 2 properties since. They bought a new property. They planned to work for 10 years medically. They had to retire after 4. And they financially could. And so back to the little bit, the one-off or the ongoing, we built that plan for them. But also at the same time, new contribution rules came in, they can contribute. The contribution caps have changed twice in that period of time. And so every year working with us, we updated that plan every time. Hey, you've sold this investment property. This is what the next few years look like. Hey, now can you afford that other house? Let us update your plans and projections. And so the plan, if they took it, printed it, had it on the fridge and moved with it every year, the plan just wouldn't work. That their circumstances changed, the share markets changed, the property market changed, and legislation drastically changed. That email came in the same time as I was talking to a prospective client who's a listener to this podcast, and it's kind of
what up?
At the same time said, Martin, we want a plan, we can see lots of value, but our next 5 years is going to be pretty straightforward. And I went, well, funny you mention that because it might be, but it might not be. And similar thing, they've got a couple of investment properties, they work for themselves, they've got different things, they plan to work for 5 more years. And I was like, well, it might, but it might not. They're like, well, we just want to pay for a plan and we'll track it ourselves. I said, well, you can, but similarly, we would charge you an ongoing advice fee that was above $10,000, but it would have equated to, particularly if you factor in rental property assets, well below 0.5% or probably 0.25% of their retirement wealth. So you're paying, you're paying 0.2% to look after 99.8% of your wealth and not make silly mistakes. And so they said, yeah, good point. Let us think about that. But that's, I suppose, that, as we know with these markets, life doesn't go in a straight line. Some people's affairs are straightforward, and they're not going to get value from ongoing advice. So do I think...
Absolutely, yeah.
Do I think everyone could get value from advice? Yes. I think get value for the price that advisors need to charge? Often not. So I'm not saying everybody in Australia needs to pay an ongoing advice fee to an advisor. Definitely not. But advisors, as you kind of mentioned, there's a capacity to how many clients we look after and different things. And so we, as a business and many advisors, would only offer ongoing advice if we purely think there's value there. And some people think that their life will be a straight line, but I think it's proved often more than once that it won't be. And therefore, looking at through that the right lens is also important as part of that. So
yeah, and my final point on that was having that advisor in your corner with even the investment strategy, whether we run a 1 to 3 bucket approach or whatever that might look like. Every year at an annual review or a half yearly review, depending on what you have with your advisor, you'll say, okay, we're getting a little bit low on this cash pool. We'd like to see that you have 2 years worth of income. Yep. Let's take some money.
Now's the right time or now's not the right time to make that change.
So if you were reviewing a client now and like, okay, we've got a year's worth of cash here. Look, let's review this in 3 months because I'm not selling equities right now.
We need to top it up within the next period of time, but this today or this week is not the right time. So we're both on watch. At some point, we need to move $50,000 or $100,000 out of this bucket into that bucket, but we've got 16 months to figure that out. My advice is there'll be a better time than the next 16 months than today.
Yep.
That kind of thing.
Now, we'll have a bit of a break, have a drink of water, couple of things. You just do not have to pay ongoing advice, but I can't just keep seeing this stuff and not say something because I've literally seen the value of it. And there was comments in the group, someone that pays their advisor. If you're paying something and you're not getting the value, stop paying.
Stop.
It's all good.
You can opt out of any agreement usually within 30 days and it stops.
I would just caution any advisors that we recommend, if you go to the RetireRight website, they do not charge a percentage base ongoing.
Agreed.
It's a flat fee. Now, it's, as you said, it's nice to anchor that back to something just so to give you an idea, perspective. So, look, we'll take a break. I also turn it up a little bit when I'm talking about this stuff because I want to create entertainment. And yeah, I just think I'm just such an advocate and believer because, full disclosure, retired financial advisor. I've seen the value.
Yeah.
So we'll be back right after this.